Welcome to our Retirement Planning 101, Senior Edition, designed specifically for those on or who are about to age into Medicare. During this presentation, we will cover why it's important to review your existing retirement strategy with a trusted broker who can compare it with other available options to make sure you have the best and most affordable fit for your specific needs. These include reviewing your life insurance policies, final expense insurance, long-term care insurance, and 401ks and other annuities. Additionally, we will cover how to pensionize your 401ks and annuities so they're protected from market loss and will last you the rest of your life. And finally, we'll discuss the role of fiduciaries and how financial advisors get paid. I want to stress this isn't a comprehensive class on these topics, and you will not be tested at the end. This is just a brief overview of the most popular types of policies you might already have and why it might be a good time to review these policies now that you're at or nearing retirement. If you have any questions during this presentation, feel free to type them in the chat or hold them for the Q&A at the end. But first, here's a little information about me. You can also find additional info on our website at setsailins.com. So let's get started. Let's start with life insurance. Do you have term or whole life insurance? Some people have both. If it's a term policy, do you know when it expires? Also, do you know your monthly costs and how much your death benefit is for? Living benefits riders. Some life insurance companies allow you the ability to accelerate a percentage of your death benefit as needed with add-ons known as living benefits riders, or LBRs for short. Examples include the chronic illness rider. It covers you if you're permanently unable to perform at least 2 of the 6 activities of daily living, or ADLs, without assistance. These include bathing, dressing, ambulating, eating, continence, and toileting. The critical illness rider. It covers heart attack, cancer, stroke, major organ transplants, and kidney failure. And finally, the terminal illness rider. It covers you if you're diagnosed with a life expectancy of 24 months or less to live. It's important to note that not all life insurance companies offer these extra benefits. Do you know if your policy includes any living benefits riders? And if so, do you know the details and payout percentages of each in case you ever had a qualifying event? It's highly recommended that you sit with a trusted broker to help you compare the cost and benefits of your policy with other providers to make sure you're getting the best value for your money. Final expense insurance, also commonly known as burial insurance. It's designed to cover the medical and funeral costs after your death. Premiums are generally paid on a monthly or annual basis until the insured's death. Death benefit coverage is typically between $2,000 and $30,000. It can also build cash value and may include the terminal illness rider. Have you compared your policy with other providers to make sure you're getting the best value for your money? Long-term care insurance, or LTC for short. Like the chronic illness rider, it covers you for a host of services known as activities of daily living, or ADLs, that aren't covered by regular health insurance or Medicare. These include bathing, dressing, ambulating, eating, continence, and toileting. A long-term care policy also helps cover the costs when you have a chronic medical condition, a disability, or a disorder such as Alzheimer's disease, but you won't qualify for long-term care if you already have a debilitating pre-existing condition. This is why it's important to purchase this coverage while you're still healthy. After the elimination period, which is typically between 30 and 90 days, most LTC policies will reimburse you for care given in a variety of places, such as your home, a nursing home, an assisted living facility, or an adult daycare. As with other types of insurance mentioned, if you already have LTC, it's a good idea to sit with a trusted broker to help you compare the cost and benefits of your policy with other providers to make sure you're getting the best value for your money. All right, let's switch gears here away from insurance and into finance. 401ks and annuities. Are your retirement assets prepared for the next market downturn? Let's quickly go over the most common types of retirement investments and how they compare. First, actively managed investments. Variable annuities are an actively managed mix of fixed and market-based funds. Annual fees average between 2 and 4% typically. They have high gain potential, but also risk of loss. There's no guaranteed income outside of the fixed portion, and they offer minimal protection during a market crash. Here's a typical example of a diversified variable annuity. 401ks and mutual funds. Both are actively managed collections of stocks or bonds where your money is pooled with others into a fund that is invested in anywhere from a few dozen to hundreds of different debt and equity securities. They typically have the highest annual fees of all investments. The average cost of owning a mutual fund is 3.17% per year. That's $3,100 per year for every $100,000. They also offer no protection during a market crash. Here's an example of an actively managed fund like a 401k in red against the blue and the gold lines, which we'll get into later. The idea here is to focus on the volatility of this line. You can win big, but you can also lose the farm, which is why in political science, we like to call this casino capitalism, which is essentially like going to Vegas to gamble with your retirement savings. And never gamble what you can't afford to lose. Also, regardless of your political affiliations, it must be stressed that pandemics, wars, terrorism, climate change, natural disasters, resource scarcity, insider trading, and more recently presidential tweets can all affect the performance of your investments daily. So please keep this in mind. In addition to that, we have fees. Everybody loves fees, right? Some examples include the M&E fee, maintenance fees, administration fees, fund expense fees, load fees, and distribution fees. Your policy may have other fees in this, but these are the most common ones. And the impact of fees is twofold. With actively managed funds like 401ks, an investor pays an ever-increasing amount in fees as account balances grow because the fees are based on a percentage of assets. Fees also strike a blow to the portfolio's returns because every dollar taken out to cover the management costs is one less dollar left to invest in the portfolio to compound and grow. So in addition to paying potentially hundreds of thousands of dollars in avoidable fees, an investor also gives up many times that amount in lost portfolio returns over time. Let's go over an example. This example is based on a mid-cap mutual fund growing at 7% annually with a conservative 1.02% management fee. Because the 1.02% investors pay annually is taken out of the percentage of the portfolio's value, the larger the portfolio, the more an investor pays. Even though the investor continues to get the same 7% average annual return, the percentage of the value lost to fees climbs higher as the years pass. In this example, from ages 45 to 65, the loss of fees increases from 12% to over 25%. In all, over the course of 40 years, the impact of fees is more than $592,000. Okay, at this point, you may be asking yourself, how do I eliminate these fees and protect my investments from losing money on the market now that I'm retired and taking distributions? Well, I'll go a step further than that. I'll teach you how to pensionize your 401ks and annuities so they last you the rest of your life. Did you know if you have a 401k with a previous employer or are retired with a 401k, you can roll it into a fixed or fixed index annuity now? If you're a public employee with a variable or mutual fund annuity, you may be able to transfer it to a fixed or FIA. Additionally, if you're self-employed with a variable or mutual fund IRA, you may be able to transfer it to a fixed or FIA. So what exactly are fixed and fixed indexed annuities? Let's start with fixed annuities. They're passively managed, non-market-based plans. They earn a small guaranteed rate of about 1 to 2% depending on the policy for the rest of their life annually. They typically carry no fees and always have zero risk of loss in a down market. They're the most conservative and also the simplest of the 4 types to explain. They also offer minimal protection against inflation. And we all know about inflation, right? It's only going up. Here's an example of a graph again. this time focusing on the blue line, which is the fixed annuity. It follows a predetermined path because the rate it grows at is guaranteed. Okay, now let's go over fixed index annuities, or FIAs for short. They have little to no fees, no risk of loss, and earn compound interest by mimicking the performance of one or more stock indexes, like the S&P 500, without actually being invested directly in the market. Basically what this means is the insurance company you purchase an FIA from guarantees you a rate of return based off of the indexes you choose your policy's growth potential to be tied to, without actually being invested in the market indexes. So it's passively managed, not actively managed. There are two ways this can be done. The first is called a cap rate, which confines interest growth in a space known as a floor and a ceiling. The floor, typically 0, guarantees no risk of loss in a down market, while the ceiling caps your annual gains at a set rate. Let's use 6% as an example, and all gains past that percentage would go to the company's profits. So your investments go up with the market to whatever your product's cap rate is, but they never lose money when the market goes negative because of the built-in floor protection. The second option allows interest growth to be uncapped, but a percentage is deducted as a spread. Let's use a 5% spread as an example. If your index earned 16% this year, a 5% spread would be deducted from your gains, giving you an 11% return. However, if your index only earned 4% this year, you would only deduct 4% as a spread, giving you 0% earned. Because of the floor, your investments are still protected from going negative. Let's look at our chart again, this time focusing on the FIA in gold. Notice how it always goes up, sometimes it flatlines, but it never goes negative. That's because of the built-in floor and ceiling features. Now let's look at that in comparison to the S&P 500, which goes up with the market and down with the market, up with the market, down with the market. So this is very volatile. It's all over the place. This is the power of an FIA. You can never lose money. Most FIAs also come with extra incentives to purchase, like bonus matches and additional benefits riders. Examples include a company may offer a 10% match on transfers and new premiums for the first 7 years. So a $100,000 transfer would receive a $10,000 bonus match on day one. That's 10%. Different products offer different matching percentages and options yearly. If you want to know what's out there, you should talk to a trusted broker who can give you up-to-date product knowledge, because every year it changes. Another example is for a small annual fee, some FIA companies offer income insurance known as Guaranteed Lifetime Income Riders, or GLIR, which will pensionize your annuity or 401k so it never runs out by paying you a set amount each year for the rest of your life, even if you exhaust your funds. Let's look at another example here. So here we have an FIA in red versus a mutual fund in the black dotted line. This hypothetical investment assumes a one-time $100,000 rollover in January 2002. The mutual fund account assumes a full investment in the S&P index, which is actively managed. The FIA, however, uses a one-time bonus of 10% of the account value, and its annual growth is capped at 6% of the S&P index, using a passively managed annual point-to-point strategy. So with here, the FIA, you see it go up 10% or $10,000 on day one, even though that year the market went down 19%. So with the mutual fund, the 401k, you lost 19% of your growth. So you went down from $100,000 to $81,000 in the first year. However, the FIA didn't lose any money. It just didn't make any extra money. It retained the past principal and that $10,000 bonus. Okay. The following year, the market rebounded 21%. So you see the mutual fund went up 21%, up to $98,000. However, you see the FIA only went up 6% because that's the cap rate for that particular product. Now, follow these two respectively all the way to the 2008 market crash, and you see the dramatic effect between the two different ones. This is, again, an example of the power of an FIA. You don't want to be here with your retirement. You want to be here. Additional benefit options for FIAs are dependent on company and product availability. Cap, margin, and bonus options change yearly depending on the market conditions, so it's important to talk to a trusted licensed broker who is up to date on what products are available and what you qualify for on an individual basis. Keep in mind that when you buy a product, you're locked in at those rates. But every year, new products come out, and they're always changing and things depending on what the market conditions allow. It's understandable that FIAs may be a little difficult to wrap your head around if you've never been exposed to concepts like caps and margins, but the main thing to take away here is that with FIAs, you have the potential for market-like growth without the risk and fees you'd have with actively managed variable annuities, 401ks, and mutual funds. Okay, so let's change gears again. What is a fiduciary? Well, according to Cornell Law Dictionary, a fiduciary duty is the highest standard of care. It entails always acting in your beneficiary's best interest, even if doing so is contrary to yours. For a financial advisor, this may mean recommending a product that results in reduced or no compensation because it's the best option for the client. Key word here, best option for the client. Now, certified financial advisors or CFAs and registered fiduciary titles aren't everything. Just because someone is legally obligated to place your benefit before theirs doesn't mean they actually do. Bernie Madoff is a perfect example. If you don't know who he is, I recommend you Google him. Ultimately, it's the advisor's actions that determine whether he or she is a fiduciary. Giving continuous, comprehensive advice is considered acting in a fiduciary role, while simply selling products is not. Don't be afraid to interview advisors and ask pointed questions about their fiduciary role and what steps they take to ensure their client's interest comes first. The main message for investors is not to get too caught up with the technical language of fiduciary definition, but instead think about what services you want from a financial professional and ensure that you get them. Not all investors need fiduciary guidance. And at the end of the day, if you're still caught up with this fiduciary role title, I recommend printing this page out and having your financial advisor sign it. You can use it as a legally binding document in the court of law if you ever find out that they took advantage of you or lied to you. Additionally, it's a really good idea to check your financial advisor's license online. So this is mine. If you are in the state of California, you can use this link to look up anyone's license. Every state has a different link, but this is California's. And there you can check to see if they're active and in good standing, as well as all of the companies that they're contracted with. Okay, and finally, how do advisors get paid? An advisor who receives both a flat fee and commissions is considered fee-based. Registered fiduciaries must be fee-only or fee-based. Non-registered fiduciaries can be commission-based or fee-based. For example, an advisor who recommends actively managed plans makes annual commissions directly from their client's investments, deducted as a fee, regardless of if their client is making or losing money. A broker like myself, who only works with passively managed plans, is paid directly by insurance companies based off of the volume they bring into the company. These commissions never come from clients' investments. So you can have peace of mind knowing that. Thanks for joining us today. I hope that you got a lot out of this. If you'd like to schedule an appointment to go over your particular situation, I'd love to sit down with you or have one of our agents sit down with you. Again, you can go to our website at setsailins.com, schedule an appointment, and also learn about all of our services. Thanks again. Have a great day.